Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show, and we're going to do something a little different today. I was talking to a good friend of mine, and actually a client, and there was some questions I get all the time, quite frequently, I should say, and it's, should I pay my house off early? You know, that's sometimes a difficult question to answer. And actually, I have a definite, unequivocal answer to that question. You know, we get told all the time that, we hear about, there's people out there that teach, and talk about paying off debts all the time, various folks. We know who they are. And there actually is an unequivocal answer, like I said, should you pay off your mortgage early? And the answer is, you ready for it? It depends. And why do I say that? It depends. Well, frankly, it depends on your situation. And everyone's situation is different, of course. Financial goals are different. The time of your life, for example, what stage of life you're in, your financial life is different. There's lots of different factors that go into your income, tax brackets, and all kinds of various different things that can come into play, whether it makes sense to pay off a mortgage, for example, early or not. Now, the motivation behind it, of course, is pretty obvious. Oh, and by the way, one thing, it's sort of a pet peeve of mine, too, I should say, is, again, there's folks out there, there's different people that, say you pay all your debt off, pay your mortgage off, and all those kind of things, like blanket statements, if you will. And here's the thing I want you to understand. When somebody makes a blanket statement that, everyone should pay off your mortgage early, or, this financial product is great, or this one's bad, and they make these blanket statements like that, what's happening is that person is sharing their personal bias. It's not, for their situation, okay, very well applied. It's the proper thing to recommend or for them to do. But again, when somebody's asking for advice or direction on these kinds of things, again, the answer is, well, it depends. The motivation behind it is, pretty obvious. And, we all know with mortgages, you're trying to pay less interest. You're trying to pay less overall. And even in a low interest rate environment like we've been for a while, on a mortgage, there's still an awful lot of interest involved because mortgages are amortized. And for those of you that are not familiar with that term or really fully understand, amortization is really quite simple in that it means the interest is front-loaded on the loan. So in other words, when you're making payments in the early, say a 30-year mortgage, which is probably the most common mortgage that exists out there today. When you're talking about a 30-year mortgage, the majority of the payments in the early years in particular are interest because the interest is front-loaded. So in other words, the lender gets most of their money up front or their profits, right? Many of you know, if you've listened to some of the previous shows, I'm chairman of the board of a bank in formation. We're in the process of opening a bank. We're pretty excited about it, and we're applying for our FDIC approval as we speak. So I've got some understanding and some background on this arena, and also I've done a lot of mortgages myself personally and through our business, over 50 of them actually, because again, if you listen to some of the previously recorded shows, you can go to yourpersonalbank.com or download the app, Your Personal Bank, and you could listen to some of my background. And bottom line is, we've invested in a lot of real estate over the last decades, I should say 15 years or so, and we've done over 50 mortgages in that process of all those times, personally and through our business. Also being a banker on the other side, so I've got some experience on both sides of it, if you will, as a customer and as a provider. I actually, for a while, when we were doing so many mortgages back in the day, a good friend of mine who was my mortgage broker at the time, I basically went to work for him part-time to save money on some of the fees that were involved and did a number of my own mortgages through him. So I was a part-time mortgage broker for a while. Not anymore. Haven't done it for years. Don't intend to go back to it. But got a lot of understanding and experience and background involving mortgages. So again, to answer the question, should you pay your house off early? Again, the answer is it depends. And there's a couple of key things I'm going to share today that are important beyond just like, the rates. I mean, those are important. What rate are you paying and those kinds of things, interest rate. Should you refi, those kinds of things. Okay, we'll talk about that. When you should refi, when you shouldn't. There's some times that makes sense and times it doesn't. So there's a lot of things involved with it. But a couple of key things I want to share right off the top. Again, the motivation is to pay less interest overall. And because a mortgage is an amortized loan, there's an awful lot of more interest is paid on it. And it's a long-term loan for most people. A 30-year mortgage is the most common. You can do 15 years. That's probably next most common time frame. Obviously, a 15-year has less overall interest than a 30 because it's not stretched out as long. Okay, so there's less interest involved. Of course, your payments are higher on a 15 versus a 30, given the same amount borrowed and the same interest rate. So there's some factors there. But here's the thing. Without I don't want to dive into the weeds in detail too much to bore people. What I want to do is help you understand the idea behind it. Now, first of all, when I say amortize, this is the first thing to really understand about it. Again, a mortgage is front-loaded with interest. Your payments in the early years are mostly interest. In fact, this is something I even learned a while back, wasn't aware of initially, that if you take a 30-year mortgage and payments, you make your payments on, your monthly payments, for the first 7 years, if you make payments for 7 years on a 30-year mortgage, over 90% of the principal is still owed, irregardless of the interest rate. The interest rate doesn't change that. It's because of all the interest is front-loaded. Now, why is this a problem? If you're making payments on a 30-year mortgage, the first 7 years, again, is mostly interest. Okay, it's front-loaded. In fact, you still owe 90% plus of the principal, the original amount you borrowed, even after 7 years of payments into this loan. Now, statistically, lots of studies have shown this, the average American, what do? They move or refinance every 5 to 7 years. That's the statistical average. Now, if you move or refinance, are you paying down your mortgage? Remember, majority of its interest, particularly in the early years. You still owe 90% or more of that loan after 7 years. So refinancing or moving, in most cases, what are people doing? They're just kicking the can down the road further, which is what the lenders love, by the way, not really paying down the mortgage. And by the way, in many cases, when somebody refinances or moves, they usually get a bigger loan, don't they? Because that real estate over that time frame hopefully has gone up in value, or they buy a bigger home or whatever. So they're taking on more debt, is my point. It's a bigger loan, more interest to front load. So if somebody does that process every 5 to 7 years, if you think about it a minute, are they really paying down on their mortgage? And the answer is no. What they're, in essence, doing is taking on a long-term debt and extending it even further, creating a lifetime of debt, if you will. So that's something that's important to understand. It's a key thing to understand. So knowing that the loan is front-loaded, all the interest is in the front portion of the loan. After you've made payments, this is the other question I'll get from folks. Should I refinance? We're going to talk about that in the next segment, by the way, and when you should and when you shouldn't refinance. But again, as far as should I pay my house off? Well, again, you're trying to save all this extra interest. And by the way, how much interest? How much are you going to pay on the total loan? Well, there's a document called Truth in Lending Statement. It's on every mortgage, when you sign all those papers, when you purchase a home or refinance or whatever, it's all those mortgage forms you sign. There's a key form in there called your Truth in Lending Statement. That's the most important document in there, because that one will show you how much you're actually going to pay in total interest. In the next segment, we're going to talk about how you can reduce your interest and how to be smart about it, keeping control of your money.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show, and we're talking today about, should you pay off your mortgage early? And in the first segment we talked about, and I answered the question, because we all know there's a lot of folks out there who share and educate and teach that you should pay off your house early. There's programs out there that people sell showing you how to pay off your house early, all those types of things out there. First of all, should you pay off your house early? Again, there's an unequivocal answer to that question. And the answer is, it depends. And again, it depends on your situation, your financial situation, your goals, where you're at in your financial life, your tax bracket. All kinds of different factors and variables can come into play on whether you should pay off your house early. And one of the questions I ask all the time, and again, I understand the motivation behind it. There's a lot of interest involved. It's a long-term loan, and most mortgages are 30-year. Some do 15, but the most common is a 30-year mortgage. And there's a lot of interest involved. It's amortized, which means it's front-loaded with interest. Most of the interest is, you pay in the first years. In fact, after 7 years of payments on a 30-year mortgage, you still owe 90% or more of the principal, in other words, the amount you owed, irregardless of interest rate. And that's interesting and ironic when you think about it. So if you move or refinance every 5 to 7 years, like a lot of people do, are you really paying down your mortgage? The answer is, well, no. Really, you're not. And by the way, the word mortgage, it's also interesting to understand. Where does it come from? It's an old law term. It was used in France and England, goes back to the Middle Ages, and it really means death pledge. What's that mean? It's a pledge that you're going to pay back this debt either when you're gone, you're going to fulfill this obligation, or when the property is taken through foreclosure. It's kind of morbid, but, a mortgage is a death pledge. You're going to pay the lender back, okay? Or they're going to take the asset. So I understand the motivation behind wanting to pay off your house early. The bottom line is, for most everybody, it's you want to pay less in interest, okay? And that's an admirable goal, no question. Should you do that? Well, there's another factor on this, and I talked about front load of interest, and the majority of the payments are in the early years, okay? So if you were going to pay down on your interest, okay, you would actually be, you could enhance the return. You would have the most impact in the early years, paying extra onto the mortgage, okay, knocking down that interest. But here's another thing to consider that's of supreme importance. I think many times more important than anything else, and particularly when it comes to any debt, but particularly a mortgage, and that is control. Now, what do I mean by that? Who's in control of the money? In other words, if you're making extra payments on your mortgage, for example, where's that money going? Well, it's going to the lender, okay? Now, let's say you made extra payments on your mortgage for a period of time, say a number of years, whatever. Again, admirable goal, trying to knock down that interest, pay less overall. And by the way, you can save tens and even sometimes hundreds, depends on the size of the loan and the interest. Typically at least tens of thousands, if not 6 digits or more of interest savings on many mortgages. But the thing is, when you give those extra payments, this is something a lot of people don't think about, and I share this in a lot of workshops and stuff I do. When you give those extra payments to the lender, who's in control of that money? Well, the lender is, of course, not you. You gave up control of those dollars. Now, let's say you made payments for a period of time. Again, you've made payments for a number of years. And then a financial situation comes about. Your loss of job, income, business, economic downturn, disability, any number of things that happen to people, real life stuff, either individually or like an economic situation, whatever it may be, where your financial situation has changed. And now you're struggling to make that mortgage payment, for example, at least for a period of time. At that point, can you go to the bank, to the lender, and say, hey, Mr. Lender, I've been making all these extra payments all these years to you. I've made my payments on time, whatnot, made the extra payments. Right now I'm needing a little help. Can I borrow some money to make the next mortgage payment? Well, we kind of all know the answer to that question. If you're financially struggling, a lender's unlikely to loan you the money. And if they were, it'd be, exorbitant rates, right? So the situation is you've given up control of all that money. In the worst case scenario, if you're not able to continue those payments, well, you're facing a foreclosure, which means they'll take the asset, take the house, and all the extra payments you made. So you're out. So one of the statements I make all the time, or question I state to people all the time, And last things I've looked at, I think the average house right now at least in the Phoenix market, we'll put it that way, is around $250,000. Okay, let's say you had a $250,000 house. Would you rather have a $250,000 house paid for? And again, the numbers don't matter; it's the principle here that applies. But would you rather have a $250,000 house paid for, or would you rather have a $250,000 house with a $200,000 mortgage and $200,000 in an account guaranteed and safe and growing? That money's not going anywhere. Well, the answer invariably is, well, yeah, I'd rather have the account. And the reason is very simple. If you had money in an account set aside in reserve, well, if you ran into a financial situation or struggling making the payments along the way, could you take funds from that account and continue to make your mortgage payments? The answer is of course. Also, if you get to the point where the mortgage and the account are similar in value, could you just pay it off at that point? Of course. Okay? The thing is this: who's in control of the money during that time frame? And one of the things I always share with people is, look, if you have the discipline to make extra payments on your mortgage, could you apply the same discipline to take that money and put it into an account that would grow and be guaranteed and safe? Then you could later access it if and when you needed it, or eventually pay it off. And by the way, if the interest you earned on the loan was the same as the interest you were getting charged on the mortgage, do you realize that you would, and you made those extra payments, you realize you'd be able to pay off the house or that mortgage in the same time frame? That's what's kind of interesting. So you would pay it off, or you would have the ability to pay off the mortgage early. You make your payments like your normal payments, of course, but the extra, I'm talking about the overage that a lot of people I run into, to pay it off down early, to save interest, right? Well, again, if you're earning the same interest rate on what your mortgage is, you're going to have enough money to pay off the mortgage in the same time frame as if you had applied those extra dollars directly to the mortgage. It's a wash. And if you're earning a little bit more interest, okay, on the money you're setting aside than your mortgage rate, which, by the way, today a lot of folks are getting mortgages in the 3s and 4s, by the way, okay? And we talk about the personal bank, okay, currently crediting 5%, okay? And there's some cost of insurance fees in there. Let's say, 4.5 is your net return, which is pretty common over long term. If your mortgage is 4, let's say, I just talked to somebody yesterday, their mortgage is 3.25. And if they're earning 4 to 5 on their money, there's a positive arbitrage situation there, which means that money in that account they're setting aside, designated to quote unquote pay off the mortgage early, would grow faster than paying it off directly to the mortgage, so they'll be able to pay it off even quicker. We ran some numbers and we shaved about an extra year off of that payoff time frame. Now again, when that happens, depending on how much you add extra, a lot of folks I work with have the ability to pay off their mortgage, a 30-year mortgage, let's say, in 7, 8, 9 years, typical. That's what I run into quite often. Shaving a year off is a big deal. Okay? So, again, it's about control. I always say, who is in control of the money? And during that time, as you're building that nest egg, setting those dollars aside, and again, they're safe. Personal bank's a great place to do that. There are other places, okay? We can discuss those options, of course. But my point is, you now have the ability to make those payments if and when a financial crisis occurs. Stuff happens. That's life. And eventually you have enough, just as if you had sent the money directly to the lender, to then pay that mortgage off if you want to. But again, in most cases that I'm dealing with a new mortgage, 7, 8, 9 years from now, you'd be able to pay it off. You'd have enough. Do you want to pay it off? And the answer to that question, again, is the same. It depends. Is the mortgage interest deduction still in place, for example? What's your financial situation at that point? Do you have other needs for that money or better uses for those dollars at that point? We can't predict where we're going to be in 7, 8, 9 years in most cases, right? Again, it's all about options and control. In the next segment, we're going to talk about refining and when it's times when it's good and when it's times not so good to refi.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking a lot about mortgages today, and should you pay it off early or not? I'm talking about a lot of these things because what I find is when I'm talking to people, and I get asked this question frequently, and there's a lot, they hear from folks that say they should pay off the mortgage early. They hear from other folks that said you shouldn't. And there's various advice that's given out there. And the true answer is really, it depends. Okay. And we're talking a lot about, the key is when you do pay off a mortgage early, who's in control of that money? And that's the key, in my opinion, one of the most important things. And like I said, I'm sharing this because, again, I get asked these questions so often. Also, I've got quite a bit of experience in this area, both as a consumer. I've done over 50 mortgages myself personally and through our real estate investment company over the last, 15 years. So I've done a lot of mortgages. Actually, in the heyday when we were doing lots and lots of mortgages, buying properties, I worked part-time for my mortgage broker to save some money on fees, frankly, because we were doing so many mortgages at the time. So I've been a part-time mortgage broker back in the day, no longer, not interested in doing that in the future. Haven't for years, but got some experience there. And of course, as chairman of the board of a bank in formation, we're in the process of opening an FDIC-insured bank. We will be dealing a lot with mortgages, particularly commercial mortgages. So again, got some experience from the mortgage broker side, from the banking side, on the providing side, and then of course as a consumer side. Here's the thing to understand about mortgages. Of course, typical mortgage is a 30-year. It's amortized, front-loaded, and the interest means most of the payments you make in the first years are interest, okay? In fact, first 7 years of a 30-year mortgage, you still owe 90% or more of the principal, regardless of the interest rate that's charged. That's eye-opening to some folks. So if you do refinance or move and start a new mortgage, you're starting over, okay? You haven't paid much down on the first one, so you didn't really move forward very much. And unfortunately, a lot of people do that. And that's why mortgages are the definition of mortgage is death pledge. It's morbid, but it's reality. If somebody refinances or moves every 5 to 7 years, it becomes that. So the key is understanding when you should you pay off the house early? Well, should you pay less interest? Yeah, that's a good goal. It's a noble goal to pay off the interest early, okay? But the key is who's in control of the money. When you pay off and you give extra money to the lender, who's in control of those dollars? They are, of course. And if you run into a financial situation or your financial situation changes and you have a struggle, again, do the things that happen to you or beyond your control? It could be the economy, disability, job, business losses, any kind of thing. And you try to go to the lender at that point and say, hey, I've been paying you this money, been paying you extra all these years, run into some struggles, can you help me out at this point? Well, if you're struggling, it's unlikely they're going to loan you the money to make the mortgage payment. And, of course, at that point, you could end up losing that asset and all the extra dollars you contributed. So it puts you in a higher and higher degree of risk when you pay the extra dollars directly to the lender. Our suggestion in most cases, in that if you're going to pay extra and you have the discipline to do that, why not set it aside in a side account? Don't risk that money because you know you want to pay off the mortgage, right? Yet you maintain control of the money during the process, so in case something did happen negatively, you could have made your payments. You're in control of the money, right? And don't risk potentially losing that property. So again, it's all about control. And of course, once the funds are there, you have enough, can you pay it off? And the answer is yes, you have the option. Do you want to pay it off? Well, that depends. Again, that depends on the situation you're at. Is there a better use for those dollars for you at that point? Where's your tax situation? All those kind of various situations. What's your stage of financial life? Is a mortgage interest deduction still around at that point? We don't know the answers to those questions, do we? So the thing is, having the option to be able to pay it off, if you want to, is key, again, with control. Now, if you're looking at a new loan or refinancing or line of credit and those kinds of things, okay, a lot of people do that. And I had a gentleman, a friend of mine, asking me about that just a day or so ago. And there's a couple of things to consider on that. First of all, if you have a current loan and you're looking at refinancing or whatever, you've got to look how far down the road are you, how far down the path are you on the current loan. Remember, it's front-loaded, it's amortized. So that means if you're halfway through, let's say a third to halfway through, you've gotten through the worst of it. You've paid most of the interest. And if you start a new mortgage, refinance or whatever, you're going to get back to where the first, 7 years of payments are going to be, 90% of the principal is still going to be owed. You start that process over again, so you pay a whole lot more in interest. Even if the rate's better, and the overall payment's lower, because you got through the worst of it, and typically in most cases, when we tell folks if they're about halfway through their mortgage, stick with it and finish it out because you got through the worst of it. And that runs against the grain of advice of a lot of people. But again, it's understanding how the mortgage works, how the amortization schedule works. Do you want to take on all that extra interest again? The other thing to consider about on refinancing and things like that or new loans is, a lot of mortgage competitors will share different rates, okay, and you can buy down the rate. You can buy down points. Like they'll market, you can get this interest rate, this rate, or somebody's got a better rate. But the question is, are you contributing more dollars to it to buy down the rate? You can add more fees to your mortgage to get a better rate, to get lower payments in the future, but you're paying the extra fees up front. Again, I'm not saying it's a bad thing to do that, but understand what you're doing going in. And that was one of the questions I had for this friend of mine, and he didn't know the answer to the question. Because I said, well, that would be important to know. So we're going to look at the numbers and see what makes sense before he commits to this refinance, for example. Okay. Also, if another case is a situation, like I said, if you can reduce your overall payment and the new rate is lower and the payments are less and overall it makes sense, you're refinancing a loan that hasn't been around too long and putting yourself in a better position, well, those extra dollars in savings, what are you doing with those? Well, if you just spend them to increase your lifestyle, is that financially moving you forward? You get a better lifestyle, certainly, but if you take that savings or that difference, like in this gentleman's case, he's going to save $1,000 a month in the refinance, his payments. And his old loan has only been around for 3 or 4 years, so he's not that far into it, into a 30-year loan. And so refinancing makes a lot of sense there. And he's getting a great rate and all that kind of good stuff. And the thing is, I say just don't ever refinance this one. Okay, finish this one out. That's $1,000 a month in savings. Well, he's planning on putting that away, investing it. And now he can push himself forward financially, which makes sense. He's not changing his lifestyle. You see what I'm trying to say? So refinancing, again, lines of credit. Lines of credit can be great, particularly for short-term use of money. That's where there's typically no points or anything like that. It's just it's like a line of credit. It's some funds you can access. Great source for folks, business people, and people who do transactions, real estate investors, and various folks like that. Good, quick source of short-term money. Don't typically recommend using lines of credit for long-term borrowing purposes, okay? But it can work. Again, those are things you want to discuss with somebody who has some experience and knowledge on this. And talking to a second party, second opinion, outside of the mortgage broker or the lender, not a bad idea. Have somebody look the numbers over for you and see if there's any gotchas or hidden fees or any of those kinds of things, like I said, which we find commonly. Those are the kind of things we a lot of times just giving people advice and help and being smarter about their money. If you want to contact us on your doing any of that kind of stuff, yourpersonalbank.com, contact us, send us that info. We'll be happy to help you out with that. There's no charge for any of that kind of stuff. It's just, again, if we're helping a client put themselves in a better financial position, often they become clients because they have some monies that's freed up to invest, right, and move their financial position forward. So we love helping folks out like that in those kind of scenarios. So like I said, there's a lot of factors involved in mortgages, either where you're talking about should you pay it off early or, should you refinance or not? Should you take on a line of credit or not? Those kinds of different things. And you want to have you want to think that through and have a plan because, again, it's debt. Whenever you're taking on debt is an obligation, and you got to be, careful about how much debt you take on. I'm talking about primarily mortgages and lines of credit here today, but in the last segment, we'll touch on a few of the other kinds of debts that are involved out there, and also in how maintaining control of your money and paying less interest there too. makes a big difference financially for a lot of people.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third, coming into home, and we've been talking today about mortgages. Should you pay off the house early, the mortgage early? Should you refi, or when should you refi? All those kinds of things. And again, I'm not a mortgage broker. I was one at one point, part-time, personally. I've done over 50 mortgages personally and through our real estate investment business. I'm also chairman of the board of a bank in formation that will be offering primarily commercial mortgages. And so, I've got some familiarity on both sides of it as a provider and as a consumer. And one of the questions I get asked very commonly by folks is, should I pay off my mortgage early? And again, the answer is, well, it depends. And it depends on your situation, of course. Blanket statements of paying off your mortgage or not paying off your mortgage are just bias that somebody's given you that might apply to their situation, but very likely may not apply to yours. So again, should you pay off the mortgage early? Those kinds of things. It's the biggest thing I think is, you want to save interest. Get that. Totally understand that. Understand the purpose behind it, but at the same time, you want to maintain control of those dollars. So our suggestion in most cases are, hey, if you're going to pay extra into your mortgage, why not take those dollars instead, apply it into an account? You don't want to risk that money, because you want to use it to pay off a debt that's there, right? So if you grow and that money grows, and if that growth rate is the same or higher than your mortgage rate, you're going to be able to pay off the house equally as fast, if not faster, than paying off the money directly to the lender. Also, during the process of that, adding that monies into that account and building up that nest egg and whatnot, you've got access to those dollars in use if you need them in case something happens. Because if you get a financial situation, you got to make the next mortgage payment. You can't go to the lender and ask them to borrow more because you've been paying them extra all this time. It's not going to work. They're not going to lend it to you when you're in financial crisis. But if you've got a reserve, you could take those funds and keep making your payments and keep that property and not risk foreclosure and losing the property and all those extra payments. So in my opinion, the control factor is probably one of the most important. Who's in control of the money, right? And when should you refi? If you're looking at refinancing and those kinds of things, if you're pretty far down the road in a 30-year mortgage, better, halfway or better, probably not because of the amortization aspects. You've gotten through the worst of it. First 7 years of a 30-year mortgage, you owe 90% or more of the principal after 7 years of payments. If you've gotten past that, more and more of your dollars are going to the principal and you're knocking it down. So you want to be very careful refinancing an older mortgage. A newer one, if you can get a better rate, make lower payments and stuff, can make sense, but be careful of the fees because you can get charged fees to buy down the rate, which can look better and make lower payments down the road, but you're paying more up front. You want to know what you're dealing with. And, there's PMI, too, private mortgage insurance. If you are borrowing more than 80% of the value of the property, you're going to pay an extra fee or extra insurance fee to the lender. It protects the lender. You're paying the premium, but it's protecting the lender, not you, from the risk of this mortgage defaulting. So there's a lot of fees and factors and things involved. And I always say, is it a good idea to have a second opinion, a second party look at this outside of your mortgage broker or lender that you're talking to? Yeah, the answer is yes. Because for a lot of people, this can be the biggest debt they'll take on in their lives. And so if you're looking at one of the biggest purchases and one of the biggest debt obligations you may ever face, taking a little bit extra time, getting that second opinion is just wise, okay? And like I said, I've done a lot of these before. We just, happily talk to folks. We don't charge anything for this. It's one of those things where a lot of times we show people where we can save them dollars, maintain control of their dollars. We can show them how to use those dollars. If you want to understand how a personal bank works more in depth, go to yourpersonalbank.com and listen to previous shows where I've recorded where I talk more about how the personal bank works. It's a great tool to help pay off a mortgage or any other debt for that matter. When you get in, let's talk about that real quick. When we get into debts where they're higher interest than mortgages, the car loans, the credit cards, the student loans, and all these other things that a lot of Americans are facing. I've read a number of articles recently. The majority of Americans are stressed out about their debt. Majority of Americans have significant debt that they're dealing with. So this is a big, big deal. Should you pay down some of that consumer debt, particularly the high interest stuff? I don't think anybody would argue against that. I mean, paying down that debt will reduce stress. You're paying a lot of interest on that money. It's really hurting you financially, okay? And it's more important in many cases, I would say in most cases, to get rid of that debt first before you took that money and invest. But the personal bank has a unique ability of you can put the money in, then turn around, access the funds, and still earn interest on it, and even get a positive arbitrage situation. Again, I don't have time right now on this show to share the details of all that. Go to the previously recorded shows, or tune in on Tuesdays at noon, 1510 a.m. or 105.3 FM. Of course, you can follow us on Facebook or LinkedIn, Your Personal Bank, or the Your Personal Bank app. My point is, learning how to use this tool, create a positive arbitrage so you could actually pay off some of that debt, particularly some of that higher interest debt, and earn some interest on it through your personal bank at the same time and not lose control of those dollars. Again, I go back to the control of the dollars. If you pay off a debt, if you take money and you pay a lender and you give them those dollars, what happens? What's happening is you give up control of that money, don't you? Will you ever see those dollars again? Now, you're trading them for an asset. That asset might grow in value and you trade it in that way. Okay. But the reality is that those dollars that you paid to that lender will never see again. Those dollars can't grow for you. Okay. Well, if you use a personal bank tool, you can access them from it, pay off the lender, pay off the debt that's there, and still earn interest on those dollars, and particularly in a positive arbitrage situation, earn money on those dollars going forward the rest of your life. You also would have the ability, if you had more money in the future, to pay those off and earn even more interest on those dollars going forward the rest of your life. In other words, what happened was you didn't give up control of the money. And money is a tool. It's not good, it's not bad, it's neutral. It's a tool. And that tool will either work for you or work against you. We all know about compound interest. Money compounds. It can grow for you. Well, guess what? In a debt, money can compound also against you and work against you just as strongly as working for you. So do you want your dollars working for you going forward and still pay off your obligations, the debt obligations that are there, whatever those may be, yet still have the ability to earn some interest on those dollars now and potentially more down the road if you're able to pay those back down the road, for example? But again, it just comes down to you maintain control of your dollars, your money. If it's in your hand, why would you give up control if you don't have to? And that's a topic or conversation I'm going to have to delve into further. Of course, I've talked about it some in some of the previous shows. Again, yourpersonalbank.com, or follow us on Facebook or LinkedIn, or download the app, Your Personal Bank. My point is this. You maintain control of your money. If it's in your hands, why would you voluntarily give up control of that? And we can show you how to do that through the Your Personal Bank tool. And that is the biggest key, probably I shared all day, and the most powerful wealth concept that I shared all day. When a dollar comes into your hands, figure out how to make it work for you, not against you, or don't give it up, because it can be powerful in the long run. Tune in every Tuesday at noon to 1510 a.m. or 105.3 FM Money Radio. Follow us on Facebook or LinkedIn, or download the Your Personal Bank app. We'll see you next week.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.